Welcome back to Morning Trade Live. Let's keep talking some tech. Alphabet's getting beat up this morning. What can we read into that when it comes to advertising, searching? Tom White's looking at the options. Dan Morgan joins us from Synovus Trust Company, Senior Portfolio Manager and Vice President. Good to see you again, Dan. Happy New Year.
Hey, Oliver.
I think I get one
Happy
more
New
day of
Year.
that. Yeah, until we get into February.
Yep.
All right, so...
Right.
Alphabet's getting beat up. Definitely the biggest decliner this morning. Do you think that tells us anything about a few of the reports still left to come?
Well, it's interesting, Oliver, because we had both Microsoft and Alphabet coming in with numbers, obviously, last night. You were talking about Alphabet coming up short in terms of ad revenues. They were up about 10.5%. YouTube was up about 15.5%. I think GCP was up about 25%. So we roll that number into Meta. The expectations, obviously, for Meta coming into this fourth quarter in terms of ad revenues, they're looking for 20% plus growth. So I think there's a lot of red flags going up that if Alphabet can't hit on ad revenues, will Meta hit on ad revenues? And then if we take a look at Microsoft, they came out last night and said that Azure, which is their data center cloud service, was up 30%. 6 percentage points were due to enhancement of their AI tools. So I'm wondering if that's going to roll into Amazon with AWS. We're only looking for 13.5% increase in terms of revenues. Will they also say that, hey, we're getting a boost because of what we're doing with AI? So those are the two things that really stood out to me, Oliver, in those reports, and how we can kind of roll those numbers into the reports that we're expecting tomorrow evening.
All right. The competition between Microsoft and Alphabet for search, now that Microsoft has got some attention on Bing through its ChatGPT integrations, a little bit more competition than usual in that realm?
Well, it's interesting, Oliver, because we hear a lot about that in terms of Microsoft enhancing their search capability through AI, and how does that stack up against Google, and will they steal market share away from their search engine? I still view, Alphabet as a dominant player in that space. I know they're doing things to enhance the experience and increase the ROI for ad customers in terms of using AI. So I think they're dueling it out. But if you look at market share, at least based on the last numbers I've seen, a couple quarters ago, I mean, Google still really led in the search space. I mean, MSN is trying to find a catch up, but I think they've got a lot of work to do. But there's obviously a lot of hope that they'll eventually close that gap.
Okay. So thinking about the transition of this market's love for AI from hardware to software, does it look like that's going to be an easy transition, or might it take a little bit of time before we start to see the needle really moved on the bottom line for some of these companies and their integration of artificial intelligence?
Well, you're right, Oliver, because at this point, only evidence concrete that we have in terms of AI has been through some of the reports that you and I've talked about. NVIDIA, Broadcom, AMD to a certain extent, Marvell Technologies, a lot of the chip companies, we were able to show certain AI chips that they were developing that were doing extremely well in terms of sales. And like you said, Oliver, it's been very slow coming over to, in regards to what's happening on the software side. I mean, we haven't heard that much. Hopefully, we'll get some more beyond what Microsoft talked about. That was more in the data server space. We'll have Salesforce reporting numbers, Adobe, some of those companies. Maybe they'll give us some sort of indication of, how much AI helped boost their, enterprise sales for the quarter. But it has mostly, like you said, Oliver, been on the hardware side and mostly on the chip space, where we've been able to see pure concrete evidence that AI is impacting, where it's been very slow on the software side.
Okay. Thinking about the difference between, secular growth like the AI implications versus cleaning of balance sheets like in the case of Meta. Thinking about that company in particular, it's been a little bit different because there's not a lot of big breakthrough new hot products. It's more just about kind of shoring up the bottom line. Do you think that's still what drives the stock for Meta? Does that kind of give it a little bit of its own story?
Well, Meta is interesting, Oliver, because like you said, they have switched from spending money on the metaverse over to AI. They do have some AI products. They have a chat box. They're coming out with a silicon MTIA, which is their chip. And of course, they're doing things to kind of enhance their experience, like I mentioned with Google in terms of customers and ROI and so forth. We are looking for ad revenues to increase by 20% in the quarter. So there is a growth component. But you're right, a big part of the Meta story in the past has been about CapEx, cutting costs, driving it down to the bottom line. You look at the stock right now, it's trading about 21 times fiscal year 2024 earnings. That compares to a multiple average over the last 5 to 10 years, about 40 times. So the stock appears somewhat unattractive based on a historical basis. But you would hope, Oliver, that going forward, that Meta would turn more into a growth story as it relates to the recovery in ad spending, what they're doing in terms of AI and so forth, opposed to a CapEx, cost reduction, increased margin, lower spending story. So we'll try to get more evidence of that on this fourth quarter when we listen to the conference call.
You got a favorite among the bunch, Dan? Any that you feel the most confident about?
Of the 5 that are reported so far, I would probably say Microsoft is probably in the lead right now. Obviously, with Alphabet missing on ad revenues, that's a little discouraging. We know that Apple, I know you were talking about that earlier in the show, they're having issues in terms of Greater China. That's supposed to be flat this upcoming quarter, and iPhone sales unit volume is probably going to be kind of flat. So you look across the landscape. Meta is a cost-cutting story. Amazon is trying to get their feet in the ground after slowdown in terms of deaccelerating growth, in terms of AWS. So it seems like right now, at least based on the numbers we have so far, that Microsoft would be kind of carrying the flag, especially in the AI software space.
All right. Always like those thoughts. Thanks for the contribution, Dan Morgan. Good to see you again.
Take care, Oliver.
All right, let's do some trading here. Tom, looking ahead, why don't we start with Meta, as it's got clear advertising connections to some of the things we've already heard, but they've spent so much time really powering up their profits that they're kind of in a world of their own.
They are over 3 billion monthly active users, and the monetization of Reels, I think that's been the real tick up for them during the year of efficiencies that they had last year, up almost 200% in 2023. So you have to take that into consideration. Google came in light with advertising revenue, but did Meta take some of that market share, because it seems like the digital ad spend market's still robust at this point. So that'll be the concerns going into this. You're seeing that pullback here today. Option market's pricing in about a plus or minus 7% move in the shares, about $27 either way. So I looked at something, it's already reacting to some of the other big tech earnings, just off all-time highs of 406 that we hit earlier this week. So I looked at something that takes advantage of higher implied volatility. You've got an IV percentile rate of about 60% at this point. So it's telling you that option premium in the near term is expanding, right? So you collect more on selling type of strategies. So I looked at something that's a little more neutral, taking advantage of that higher implied volatility going into the event risk of earnings tomorrow after the close. So looked at selling an iron condor, going out to the February 2nd weekly cycle. So just a couple days till expiration. It's really short term. Time decay or theta is going to work in your favor and really ramp up over the next couple days, especially after that earnings report. So selling a put vertical that's out of the money, 365 put, buying the 360 put, and then selling the 415 call that's above that all-time high. Sell the 415 call and buy the 420 strike call. So short $5 wide neutral iron condor here. You're collecting roughly about $2.30 credit on it. That's what you can make. You got $270 in risk, but you got nice wide break evens of about 362.70 on the downside and 417.30 on the upside. So just about that one standard deviation. So if you're expecting maybe a good earnings report, maybe it just consolidates. This is the type of strategy that works for that. And you're doing it with higher implied volatility levels, which allows you to collect more premium.
Okay. So, correct me if I'm wrong, you're buying spreads on both sides.
Selling both.
Selling both spreads. Okay, so we want it to stay where it's at.
You want us to stay within those break evens. Time decay is going to be in your favor, and then we'll see that vol crush post earnings. So this is taking advantage of that higher implied volatility.
All right, so you get benefit from a wide range of outcomes.
Yep.
For Apple, you've structured something a little bit more positive, a little bit more bullish.
Yeah, a little bit, but still giving myself some room to the downside. Now we pulled back from those all-time highs. There's concerns about iPhone 15 sales and how much of the services can pick up the slack there if it's a choppy quarter. Now, they guided in line for this first quarter during their last earnings report. That kind of hit the stock initially. But if they beat that basically unchanged line as far as revenue goes. It might be a positive for them. So I looked at something, takes advantage of higher implied volatility also, looked at selling a cash secured put, and this is a strategy if you're comfortable owning the shares. It's not a pure earnings play. I went out to the February monthly cycle, so 2.5 weeks till expiration, and I just sold an out of the money put here, the 182.5 strike put, collecting roughly, I've got a 290 credit on here. It's closer to 350 now because the stock has continued to move down, but the credit that you collect takes your break even. If you collect 290, your break even is going to be 179.60 to the downside. That's about 3% below the current share price. Option market's pricing in about a plus or minus 3.5% move, so you're right there. But this is a type of strategy where, hey, if the stock goes higher or remains where it is, you're going to make money. And even if it goes lower but remains above that break even, just below 180, you're going to profit on this one. Hey, and if it falls significantly, you only do this type of strategy if you're comfortable owning the shares on this one over the next 2.5 weeks.
All right. More straightforward here. Selling the downside in Apple. Okay. Looking forward to get through that high, ideally, that it's been struggling with. All right. Thanks for the trades, Tom.